Guys. So we shall start, I suppose, in 3, 2, 1. Let's go. Welcome, guys. My name is Walter Peters, and I wrote the book called Naked Forex, and I know some of you have probably read it, and I'll tell you what you need to know so you don't have to read it. Basically, what we do, my friend and I, what we do is we wait for the market to get to horizontal support and resistance and print reliable patterns. What is a reliable pattern, you ask? Well, it depends on who you ask, and it depends on what you've tested. Now, typically, when the market gets to these spots, this is the pound New Zealand, by the way. And typically, when the market gets to these spots, it doesn't actually print a reliable pattern, but once in a while it will. So a lot of times, I don't really get a trade unless it gives me something really, really excellent. And so you can see here, for example, I just pulled this chart up at random. Aussie and Kiwi, let's do it. We will use the Aussie and Kiwi. This is the pound Kiwi. So you can see how there's this is what I would call minor level of support over here to the left. And it got there again more recently, like right now, basically. This is a minor level right here. And if you go down to a lower time frame, this is the daily. If you go down to 4 hour, you'll see exactly what I'm talking about right here. See how all those candles bounced off this level? 1, 2, 3, 4, 5, 6, 7. Broke, came back up, retouched it on the way back up, broke through, and then just skyrocketed up there. And actually, it's interesting how even when it breaks through, it comes back to retouch it. The line chart, if you can't see these, the line chart will really help. What I was talking about was this little touch right there. That often happens. In fact, my friend of mine, Dennis, he just trades that move right there. So, and there's another one right there. So when you get that break through the horizontal level, oftentimes it'll retouch it on the way back. And I'll show you actually one that could be setting up right now on that type of a move. But let's move over to the Aussie, and the Kiwi FX ambassador has requested. And then I want to talk about a number. Really, today's session, we have plenty of time to go over the charts, and I'm happy to do that. But today's session, we're definitely going to talk about this one number that you must keep in mind when you are trading. It's absolutely critical, and it'll actually help you quite a bit. So let's bring up the Aussie and the Kiwi. I also want to mention that the Aussie yen is in this big, huge box that I've drawn here, this orange box I've drawn on my chart. And eventually it's going to get out of that box. And if it does, I'm going to wait for that retouch up. You know, if it breaks out to the downside, which I suppose it'd be more likely at this stage, 85.20. If it breaks down here and then comes back up and touches 85.20, I'll sell with a bearish candle, a big red candle. And likewise, if it breaks out to the upside and then comes back down and settles on 87.0, well, basically 87.10, and gives a big bullish candle, I'll buy. But let's bring up the Aussie and the Kiwi because we would. All right, so a lot of people are really bullish that the other day. And how do we know that? Well, you can actually see what I use. It will just forward you through. But this is a link from my website. It will just send you back straight through to the numbers. Go to fxjake.com/crowd. What you'll see is something like this. This is the Owanda open position ratios. And what you'll notice here is that all right, this is turned around. Last week it was a little bit different. Actually, most people are short here. Okay, so this is what I want to highlight. Okay, so gold and silver are a little bit different because not a lot of traders are taking those trades. So on gold and silver, I really look for like an 80, 85% ratio, and then I want to be in the other side, in the small group. The reason why you want to be in the small group is because the small group is the one that's making money. The big group is the one that's losing money when it comes to retail traders. So for example, on the other pairs, 70% is pretty good. 75% is pretty good. So on the Euro Swiss, I want to be selling Euro Swiss. Why? Because almost 77% of the traders are buying Euro Swiss right now. So definitely want to be selling Euro Swiss. And for those of you that follow my videos, I was talking about this earlier today. Also, I want to be selling silver, and I want to probably, well, these ones aren't really good enough down here. Really, that's about it. Silver and, even silver should be closer to 80. Yep. So that's one thing to keep in mind, is that you can tell where people are at there. Now, let's go through here and talk about the Kiwi. So first thing to notice is that the Kiwi has historically come up to around this level and failed. And you can see that. I'm going to get rid of these trend lines over here because they're bugging me. They're old and they're from a different time frame. So see how we have these actually, I should draw this a little bit lower. The line chart will help you identify that. So there's a double top there, there's a touch there, there's a touch there and there. It briefly broke through, but then came back down and collapsed. And now we're here again. And what we have here is a bearish daily candle setting up. Now, this is kind of a rare formation. You don't see this all that often, because what you see if you went to the 4-hour or the 8-hour or lower time frame, you'd see something like this happening, where you have this wedge, right? And that wedge is basically coming to a point, and today is basically that point. So if we get a bearish Kiwi candle today, if it closes like this, that's what we call a bearish kangaroo tail. And I would be looking to sell tomorrow after the Asian session. I wait for the Asian session to maybe possibly trade lower, and then that sets the bar, that sets the spot where I want to sell. Now, if the market doesn't close with a bearish kangaroo tail today, and we don't even know because New York hasn't even opened yet. We've got a long ways to go before the end of the day. We're only about halfway through. But when I think we are actually about halfway through, but when the market closes at 5 p.m. New York time, I'll have a look and see what this daily candle looks like. But it's looking quite bearish now, so it's definitely providing potential for a sell trade tomorrow. And so let's say that it closes like this, okay? So that would be a bearish kangaroo tail. The open and the close are in the bottom third of the candle. The open and the close are inside the previous candle's range. It's at a previous level of resistance and support, and it's got a nice long tail that extends beyond the recent high. So it's got space. It's plenty of space. You can see, look, the space can be pulled across all the way to here. The last time the market printed at this spot was, how many candles ago was it? 63 days ago that it did that. So that's plenty of space. It's got all the real hallmarks of a of a trade. The interesting thing is that it's like a failed wedge, because oftentimes what these wedges will do is they'll break out in the direction of the trend. The trend has been up, as you can see here on the 4-hour. So it really is a reversal trade. It's for those traders who like to trade reversals, and I know most of you listening to this do. Most traders prefer to take reversals and don't like to go with the trend and expect it to keep going forever. But we'll see. This looks really good. So we'll see what the daily close is like. But at the moment, it's looking really good. Is that clear? Everyone cool on that? Let me know if that doesn't make sense. I'm going to shift over now and go to the Aussie. If I can find the bloody thing. There it is down there. Okay. All right. So I'm really into the red and white charts. Now, I'll be honest with you. I have been, because I'm normally not honest, right? I've been waiting for this pair to get a little bit higher. And the Aussie cat also. I've been waiting for this pair to get up to here. I really think that a move to 77.20, 77.30, 77.50, that's really kind of the call here. So this is what could be happening here. And we don't know, but I just want to point out that there's a couple of possibilities here. One is that the Aussie, when it finally, it sat down there for so long at this level and finally broke through the 70, what is it, 75, 80 level, and exploded up there. It's just coming back and it's just going to bounce off 75, 80, and then it's going to make a run at 77. Okay. That could be the case. If that's the case, then we have an opportunity to jump in on the bounce down here. Now, what would that bounce look like? Now, I've moved to the 4-hour, and I'll tell you that I think that a bounce down here would probably look like a really big bullish candle, maybe like this one. Does everyone see this candle right here? It could look something like that. Here, let me pull it across for you. It could look like a big bullish candle like that. It could also look like a kangaroo tail like this one right here. Okay. This one right here. It could look like that as well. But it needs to be a signal that, the market is going to respect this level. It doesn't look like that's going to happen, depending on how the next 2 or 3 candles print on the 4-hour chart. It really looks like it could go down there and sit and then break tomorrow. But at this stage, we really need to pay attention to what happens here, because if it gives a really strong bounce off 75.80, then I'm going to go long and I'm going to target 77, 77.10. I know I've got my zone drawn up there at 77.20, but 77 even or 77.05 or 77.10 is a safer target, because it could just barely brush up against there. If, on the other hand, the Aussie comes down here and sits here, and when I mean by sit, I mean multiple candles just sit here and it doesn't move away from it. Not like 5 out of 9 candles or 7 out of 11 candles sit here and just squat right on 75.80, then it's going to break. It's just pausing and the trend is going to re-engage and it's going to start a downtrend. So that's how I see the Aussie. It's a little bit more complex than the Kiwi, because unless the Kiwi completely reverses and prints a really big bullish candle, it's going to be bearish tomorrow. Whereas the Aussie, we might not even know on the daily chart. We're going to have to wait, and we might have to wait 24 to 48 hours before we see, is it going to bounce off that level? Is it going to give a really strong bullish 4-hour candle off that level, which again is 75.80? Does that make sense? Everyone cool on that? Let me know if it's not, if it's not making sense, just let me know, okay? If you're like, what the heck is he talking about? Just let me know. Okay. All right. So now I want to talk about the Euro Swiss. I actually haven't looked at it there it is. Okay. Holy frijoles. Okay. All right. Now, this is what I was talking about with the Aussie, but in reverse. Right? Let's get into this. So, our good friend the Aussie is headed toward that zone, and here, let's put them side by side. This might be good to see. And while I'm doing this, I want anyone here who has your numbers for your trading system, like for example, your win rate and your average winner and your average loser. If you could put those through in the chat box, we'll use your trading system as an example, because we're going to get into some number crunching in a moment. Okay. So what we're looking at here are 2 charts. This chart on the left is the Aussie daily, And the chart on the right is obviously the Euro Swiss daily. Now, what happened here with the Aussie was this was what we call a squeeze play. So the market was tightening up on right here, and the trend line kept pushing it into the horizontal level, and it finally just popped. Now it's coming back down, and ideally it would bounce at the intersection of where the trend line and the horizontal support and resistance zone is, right? That's the ideal situation. But we don't know. We don't know if it's going to do that. Now contrast that to the Euro Swiss. The Euro Swiss has broken through, has broken through this zone here at 10, what is it? 10, basically 107, 106.90 is what we'll call it. It broke through, spent some time down here and bounced hard, then came back up and is bouncing hard off of it. So whereas this one, the Aussie, we're waiting for the retouch, we already have the retouch right here on the Euro Swissy. So we don't know what's going to happen on the Aussie. It may not offer that retouch, whereas the Euro Swissy has already given it. They're just mirror images of each other, and the Aussie is a little bit cleaner because the Euro Swiss is a little bit more choppy and volatile, but they really are a very similar chart, just kind of in reverse. So now what I want you to notice is that today, so far, we've made a low of 106.40. And if you go to the 1 hour chart, you'll notice that that low was made just kind of at the tail end of the Asian session down here at 106.40. So what I'm going to do is I'm going to place an order to sell Euro Swiss below the wick of today's low, assuming that we've already seen the high of the day, and I'm just going to sell off that low. And remember, when we looked at the open position ratios of the retail traders at Awanda, what did we say? We saw that most traders are doing what? They're going long, and I'll bring it over here for you. They're going long Euro Swiss. In fact, it's the most aggressive. Here, let's refresh it. I think it's refreshed every 15 minutes. 76.55%, 20 minutes, every 20 minutes. 76.55% of the traders at Awanda are going long Euro Swiss. So we can be in this 23% minority if we take a trade here, which, believe me, is a great place to be. And if you don't believe me, you can go back and look at the historical open position ratios versus price and see when, 75, 80% of traders go one way, see if price goes the other. You may be amazed. All right. So that's my trade today, is essentially 106. So the low's at 106.40. I'll put my order in there. Actually, the low is at 41. So I'll put my order in there at 106.35, 6 pips lower. 106.35. Where does the stop go? Here, let me give you all this stuff, okay? 1.0635. Stop loss goes up here above the swing high, above the bullish white candle there. See that? That high is at 107.05. That's right. So we were talking about this morning. I sent out my video this morning, 107.05. And then let me back this up. Now, this is the part where sometimes people go, huh? So what is that risk there? What's the quick math on that? 106.35 to 05 is 70 pips, right? So it's 70 pips of risk, which is not a lot really on a daily chart, but it's kind of like a USD Singapore dollar chart. They don't move around that much either. Okay. Now, what's great about this, guys, is that we've got this squeeze play action happening where the trend line has been forcing price down into this horizontal level. You can often get a really violent move when you play these. And what's nice about this is we didn't get the violent move beforehand, before the retouch. It's probably, if it's going to happen, it's probably going to happen now after the retouch. So this is a really good looking trade. I like the way it looks. Looks really good. Now I want to show you something because some people get stuck here. They go, well, okay, that's great. I understand why you're doing this, but what about like where's the where a target? What's happening here? In terms of targets and all that. You can see there's one zone down here at 105.80, which is really not, it's not really far enough for a really good reward to risk ratio. However, this one here is at 105.44. Yeah. So if we were looking at a target, 105.40 would give me 75 pips. So it would actually be, slightly better than that, right? And the next one, here where these highs are, do you see where all those highs are lining up? Right there. And that is 80. So we could call it 104.90. But that is a term squeeze play. It's a little bit different from the Aussie because the Aussie did the explosion kind of on the break, and now it's kind of coming back. Whereas this one, if it's going to do the explosion, it's going to do it soon. Most likely in the next 2 to 4 candles, it's going to go. So, and it's either going to stop out, one or the other. But I'll take that trade all day long. So there you go. So that is an example of a squeeze play with a retouch. Now, are there any other charts that you guys want to see? Who has their numbers? I'm going to take a pause, and what I'd like for you to do for win rate and your reward to risk ratio. If you don't have your reward to risk ratio, all you really need is your average winner and your average loser. An average loser. Yep. So type that into the chat box if you have it, and we will go. And I'll show you something that's pretty cool. Right. And if you have any other charts you want to see, type those in too, and we'll get to those in a minute. So I'm going to take a sip of my tea, and I'll be right back. All right. Here we go. So if you have one second. So if, for example, if you had a well, let's see what would, if we were targeting, okay, let's say that my average winner is, first of all, if you don't have these numbers, you're in trouble. Let's say my average winner is 150 euros. And then my average loser, 75 euros. So obviously I know I'm 2 to 1. So I'm at a 2 to 1 reward risk ratio, which is awesome. But I'll show you where traders get into trouble. Now, I also know that my win rate on my trading system is roughly, let me see here. One second, I'm just Okay, here we go. Let's say that my win rate is let's say my win rate is 60%. Okay. So I've got a 2-to-1 reward risk ratio, and my win rate is 60%. That's my trading system. It could be several trading systems that are all kind of pooled together. It doesn't really matter. All right. So if I've got a 60% win rate, then we're talking about this area right here. So this is where I'm at. Actually, this is exactly where I'm at right here. This one, right? So this this is where I'm at. So what is this telling me? What is this chart telling me? And I'll tell you guys how you can get a link to this so you can download it if you want it. But and also I'll show you something even better. But basically, I'm at 2-to-1 reward risk ratio. That's what this column is saying. So all the trading systems here, 2-to-1 reward risk ratio. So the average winner is twice as big as the average loser, and the win rate's over here. So I'm in this spot on the chart, and then obviously I'm risking 5% per trade, which is probably way too much for most traders. Most traders, 2 to 4% would be probably the max they would want to risk. But feeling really good, and things are going really well with my my system. So that's why I'm going to go ahead and do that. Now, what's interesting about this is the number that is in here is telling me what is the likelihood that I'm going to ruin, risk of ruin, or blow up my account. That's the most important number that we're talking about today. The risk of ruin. The risk of ruin, basically, the risk of ruin is why traders quit, change systems, and otherwise give up or are unable to make it work. It's because they don't understand this concept, which is essentially nailing down and knowing, am I risking too much given the parameters of the system? Now, there's a whole bunch of different methods or mathematical ways of keeping on top of whether or not your live trading matches your back testing, and whether or not your predicted win rate and your predicted reward risk ratio is falling within the normal expectation, the normal variability in your live experience. In other words, am I still trading the system that I think I'm trading? But we're not going to get into that today. Maybe we can cover that in another webinar. But for right now, what we want to talk about is this, which is I have a zero chance of blowing up my account unless my broker goes bust, or I mess up and take the wrong trade, or take a trade that has too much risk. So instead of risking 5%, I risk 50% on a trade by, entering an extra zero or something like that. Unless I do something crazy like that, what's probably going to happen is I'm not going to blow up my account, given that I stick to this, right? So that's good. That's great. Now, let's say that I trade for a couple of months. I've been doing it for 6 months, and I'm starting to feel really, really good about myself. So then I go, you know what? I'm going to trade 10% risk per trade. So I'm really going to up the ante, right? Now, that may seem like a good idea, right? And maybe, it is a good idea, but I've already increased my likelihood of blowing my account when I do that. So it's not a whole lot that I've done it. It's not even really 1%, but it is noticeable, right? It is noticeable. That 0.04% is what that means, likelihood of blowing up my account. So I still have a 99.96% chance of not blowing up my account if I keep trading that system, but I have increased that. Now, what happens if I have a few trades where the market goes almost to my profit target, but then reverses and comes back out and stops me out at break even or even a loss. Well, I might consider changing my rules or saying, you know what, the market's just a little bit weird right now. Maybe I'll take profit a little bit earlier or take some profit at 1-to-1 and then take some other profit at the 2-to-1 target that I normally have. Well, if I start doing that, what I'm doing is I'm actually shifting where I am right here on the chart. I'm shifting from this spot over to that spot. Now, I might not go all the way over here because I don't have an average winner the same size as my average loser, which is what this 1-to-1 means. But I am somewhere between 0.04% and 1.7% likelihood of blowing up my account because I'm if my win rate were 55%, you can see that I'm literally going from this spot right here, which is 0.187%, so not even 1% likelihood of blowing up my account, to all of a sudden a 13.4% chance of blowing up my account. That's a huge leap. And that's something that people don't necessarily realize, that when you start changing things, when you start changing the way you're trading by taking profit early, you actually increase the likelihood that you will blow up your account. Does everyone see that? Does that make sense? Why that is the case? That is the case because we think in terms of the last trade instead of, a way for me to stick to my rules. People are focused on the outcome. That's the problem. Traders should be focused on the process of executing your system and not the outcome, because we have no control. Let me ask you, does anybody here know when you take a trade, right when you get into the trade, you know that it's going to be a winning trade? How many traders here can say with certainty that when you get into a trade, you know it's going to be a winning trade? Anybody? Anyone in here know that when you take a trade, it's going to be a winning trade? The answer is, of course, no, we don't. We don't know when we take a trade. In fact, that's what trading is all about. We've got to embrace the uncertainty because we get paid to take risk. Plain and simple. If we knew what was going to happen, then everyone would be doing it. The reason why trading is so difficult for many people is because they focus on the outcome. They focus on, well, last time I did that, I didn't quite get to my 2-to-1, so this time I'm going to take profit when it gets 1.7-to-1. Or, the last 3 trades I've taken have been stopped out. The markets are a bit choppy now. I think I should just take profit at 1-to-1. Or whatever the reasoning is, you're moving away from a system that has a very low likelihood of blowing up your account to something that has it much, 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 much higher. Okay. Now, if you guys want this, if you want this spreadsheet, all you have to do is email my assistant Candy. If you send an email ask at fxjake.com, she can send you a link to that spreadsheet if you want to download it. But there's something that's even better than that. What I want to share with you now is something really cool. All right, let's see if these numbers have changed. I just want to see real quick. They've updated. Yep. So it's even more. Oh, more people are going long silver, right? Okay, cool. But it's still, you're still at 70, almost 77% are going long the Euro Swiss. All right, let me show you this. This is called the risk calculator, and it's basically going to allow you to do what we just talked about, but it's going to make it much more. So you go to fxjake.com/risk, and the risk calculator is going to be awesome. You're going to love this because what this does is there's a video here that shows you how to use it and everything. I'll put this here. I'll put this in the chat box so everyone has it. Cool. All right. So essentially what you would do is exactly what we did before, which is, okay, let's have 55% win rate. My reward risk ratio is 2 to 1. I'm risking 10% per trade. So over the next 10,000 trades, I want to know, am I going to ruin my account? Right now, there's there's an important thing to keep in mind here, which is there's a couple of different ways to calculate this. One is to just to run many iterations of that system and see where it falls, and then take the average of that, and that's Monte Carlo data, right? If you're familiar with, when you're trying to verify systems and everything, Monte Carlo data can be very helpful. If you just go by the book, the formula sheet, then you would go with something like that, right? So that's just formulaic, whereas this is Monte Carlo. So what will happen is the Monte Carlo number will change over time if you keep clicking calculate, whereas the risk of ruin formula won't. Okay. Now you can also say, well, I don't really care about blowing up my account. I'm not going to risk so much. I'm going to blow up my account. But am I likely to have a drawdown of 30% if I'm risking? So if that happens and you're bumped, that's not good, right? 30% drawdown. Does that make sense to everyone? So that's basically how you use it. Again, this is fxjake.com/risk. And you really want to know, like, here's the thing. Risk of ruin obviously hurts, and that's terrible, and it just means you've got these numbers wrong. So either you need to change the way you're exiting your trades to bump up your reward to risk ratio, or completely change your system to change your win rate. But the drawdown is really where most traders run into problems. You do it anticipate 80%. That's true. So you have stats, Steve. So you have stats that says that when you take a trade 80% of the time. So basically, you have an 80% win rate, right? That's basically what you're saying, which is great. Sometimes what will happen is people have really high win rates. You have to be careful because the reward to risk ratio might only be 1 to 1 or 0.9 to 1 or something like that. So if I had an 80% win rate and and the best system I have is about a 79, 78% win rate, around that area. But let's say I have well, there are better systems, but they just don't trade that often. Like higher win rates, I mean. But if I'm trading 5% risk per trade, I'm risking $1 to make 90 cents. Over the next 10,000 trades, I am about 25% likely, or a 1 in 4 chance of hitting a 30% drawdown. This is why people freak out with trading. It's really that. That's the reason why. Because they're not ready for the drawdown. Or here you can see here is almost a 33% chance. So you can see every time I click this, it's going to recalculate it because it's running Monte Carlo in the background, and it's going to be different on 25%. Could be as low as 21%, could be as high as 29%, but it's right around 25%. So taking profit even earlier, which is really kind of the risk of this style of trading where you have a low reward to risk ratio but a really high win rate. What tends to happen is people don't like likelihood that they're going to start to run into trouble and have that drawdown that they don't want to have. So what do you do with this calculator? What you do is you get your system numbers, you put them in, right? The calculator. You put in your win rate, you put in your reward risk ratio, which obviously is just your average winner divided by your average loser, and you come up with the drawdown that you don't want to have. Now, for most traders, a 20-25% drawdown is horrific. If you think you can sit through a 50% drawdown, you probably can't. Most traders won't be able to psychologically get through that. But regardless, you can set up your numbers by changing this, the amount at risk per trade, assuming you use the same, consistent amount for every trade. You can set it up so that it's unlikely that I'm going to have a 30% drawdown. So even if I'm making 80 cents for every dollar I risk, as long as I maintain my 80% win rate, I can risk 2% per trade, and I'm highly, highly, highly unlikely to get a 30% drawdown. Does everyone see that? So what you're trying to do is backwards engineer your system so that you don't experience that drawdown that's going to make you want to quit. That's essentially what this is all about. Okay? Are there any charts that you guys want to see? So again, this is where you get that. I'll put that on the chart. Let me know if you have any other charts you guys want to see. I really like the Euro Swiss right now. If you want the spreadsheet that we talked about, you can email candy@fxjake.com. And if you want the risk calculator, you can just go here and get the risk calculator. All right? Cool. Any other charts that you guys want to see? I will mention that I like the CAD yen was kind of interesting too. I know I mentioned the Aussie yen. So the Aussie yen, if it can break out of the low of this box here, I'll be interested in a sell, especially if it comes back up and retouches it. And then our CAD yen, I was looking at the daily actually. Looks really good. Basically, see how we're down here on support. If we can break through this, we might get a retouch. So kind of like what we were talking about before. If it actually finally breaks through this sometime this week and then comes back up, spend some time down here, print several 4-hour candles, comes back up and touches it, I would love, love, love to sell it right there. So that's basically it. That makes sense, guys? You all good on that? Cool. All right. Well, thanks so much for your time. I really appreciate it. I hope that you guys have a wonderful trading week. And I hope to see you next. When are we on next? I think we're on Thursday, right? Cool. Thank you. Thanks, guys. Thanks, everyone, for your time. I hope you have a wonderful week. Take care. Thank you. Okay. Bye. See ya. Bye.